Hi, I'm Clint Sneed, and I wanted to take a minute to make sure that we really help you understand what we mean when we say a more diversified investment philosophy. Because when you think of traditional investments, most of us just invest in either stocks, bonds, and cash. So our approach to investing, we actually incorporate a lot of tangible assets. So let me first explain, well, what is a tangible asset? So think of a tangible asset, it's a physical asset that someone wants to compensate you for the use on their own behalf. Like a rental property. You own the home, but someone wants to rent that home from you. You get the cash flow from the rent, and you also would like for the house to continue to appreciate. So that's what we do when we develop this into our investment approach. So why did we come about this approach? Well, every one of us wants to use the top investment advice. That's why most of us have then started to use stocks, bonds, and cash. Should we listen to the richest and the wisest man to ever live? Absolutely. He's quoted as saying, diversify your portion amongst 7 or 8, for you do not know what disaster may come upon the land. That was King Solomon around 930 BC. And that wisdom is what we've used to incorporate and to build our entire investment philosophy around at this firm. To put that into perspective, 1/7 is 14.5%, and 1/8 is only 12.5%. So are you really diversified with different types of stock when more than 50% of your entire portfolio may still be invested in stocks? Well, yes, but can you get additional or more diversification if you use a different asset class altogether? So let me give you an example of this. Let's take a look at real estate. Wall Street offered real estate investment trusts, also known as REITs, decades ago. And the goal is to help an investor get diversification into that asset class. So the problem is that real estate investment trusts, REITs, are now even more volatile than stocks. So where's the diversification now? Compare this to owning directly private real estate. Yes, we have to recognize that you don't get the same amount of liquidity. There's a process involved to sell a piece of real estate, but that process actually reduces volatility. It means that people won't go through the process of selling a piece of real estate unless they actually know they want to go through with that. And so what that does is it reduces the volatility, and it also tends to give them a little bit more stability in price. So this means that there's a much different risk to return ratio in direct private real estate. And so my question is that offering now more diversification? Here's another example, farmland. It's a very basic concept. You own dirt, and yet a farmer wants to rent that land from you to plant crops. So now let's look at the components of that investment. You only get 1 to 6% a year of appreciation is what historically farmland will do, but you also get the rent from the farmer. Now you combine those two aspects of the return and you have an upside that's very similar to long-term stocks. But what about the downside? Think about it from this perspective. It's tied to food supply, and so it handles inflation much better than stocks or real estate or even gold. But it also has less downside volatility than stocks. Did you know that in its entire existence, they've been tracking farm prices? Farmland has never had a negative single year. In fact, that only twice in its history has farmland actually had negative back-to-back quarters, but never 3 quarters in a row. So now when you look at the upside return of farmland compared to a much different downside risk profile, that's the example of how using a tangible asset in an overall portfolio can maybe offer more diversification. So if this is something that you're asking yourself, why don't I already own farmland? Well, give us a call. What I'd like to do now is introduce you to Elliot Stone. Elliot is one of our other advisors here at the firm. What I'd like Elliot to explain is how he appreciates our investment philosophy and how he incorporates that with his client relationships.
Hi, I'm Elliot Stone, and I'd like to share 3 reasons why my clients value and appreciate private assets. 1 is greater diversification. Most clients know to not keep all their eggs in one basket, but we believe they shouldn't keep it all in one market too. For instance, one of our investments transports food up and down river channels and is designed to deliver double-digit income no matter if the market is up or down. Second, top-tier asset access. We've built relationships with the elite investment sponsors across industries in the United States. While these opportunities usually require $500,000 to $1 million per deal in minimums, we're able to offer them to our clients at much lower levels. Take, for instance, concrete manufacturing in the Southeast US. It's a booming space tied to migration of both families and businesses. Our clients have gained access directly to this opportunity without the typical wealth barrier. Lastly, on lower volatility, many people have endured decades of market whiplash from Black Monday through COVID, and they're ready to have good returns with greater calm. One land investment we love offers average 10% returns with bond-like stability. That kind of peace of mind matters a lot to our clients.